Hello everyone and welcome back to New Roots Abroad, where we provide you with tips, information and insights that can help you flourish in your life in the US, UK or Canada, especially if you're new to the country or plan to relocate to these countries. For more great content on thriving in your professional career, personal finance, education, immigration, and settling in your new domicile, please subscribe to the channel. So, what are the pros and cons of investing versus saving? With saving, your money is relatively safe and you don't run the risk of losing money. In fact, if you can get a high yield savings account, you can grow that money, albeit at a very marginal rate. On the downside, your money might actually be losing value due to the low returns typically available for savings accounts compared to the inflation rate. If the inflation rate is higher than the savings rate, the buying power of saved funds reduces year on year and your money effectively loses value. What about investing? With investing, you can actually significantly better your returns than you would with a savings account. There are also a wide array of investment options which encourage diversity and the ability to hedge the investment risks. On the flip side, with investing, you can lose a significant portion or even all of your invested funds, sometimes in a relatively short time. At the end of the day, while saving is definitely safer than investing, you really cannot build generational and sustainable wealth by just dumping money in a savings account. Alright, so let's use an example to illustrate this. Assuming you're just starting your savings or investment journey and you're able to put away $1,500 on a monthly basis. Let's look at two scenarios. First scenario, we have all that money put into a savings account with an annual interest rate of 1.5%, which is pretty high for a savings account. In the second scenario, we have all that money poured into investing and let's assume an annual return of 8%. Over a 10-year time frame, the savings scenario would end up with a total value of $194,000, with $14,000 being interest paid on the principal amount. Comparing that with investments, over the same 10-year time frame, $194K turns into $274,000, and that's a difference of $80,000 between savings and investing. The difference increases substantially as the years go by, as shown on this table. After about 30 years, the difference between saving and investing is a staggering $1.5 million. Naysayers might say you are not guaranteed an 8% annual return from investing, but we can assure you that this is very achievable and you don't even need to be an investment guru to achieve this. The S&P 500, which is the top 500 companies in the United States, have returned an annual return of over 13% in the last 10 years. For example, if you had bought into an index fund that tracks the S&P 500, you would have more than doubled your investment in the last decade. So, in our view, if you really want to grow generational and sustainable wealth, you've got to take an investing approach. Before we move on to talk more about investing, it is important to go through a few key definitions, and while some of you might already be familiar with these definitions, we still want to go through them for some of the viewers that don't. First up, stocks. These are essentially securities that represent ownership in a public listed company. All public listed companies have their stock listed on an exchange. Investors, through the exchange, can purchase these stocks, thereby owning a part of the company. Each stock is identified on the exchange through a ticker symbol, which is usually a series of letters. Some of the popular ones are AAPL for Apple, TSLA for Tesla, MSFT for Microsoft, and so on. Next up, bonds. These are essentially loans to corporate and government entities. Investors buying corporate or government bonds are essentially lending money to these entities for a guaranteed return referred to as the coupon rate. Bonds can also be bought and sold on exchanges, much like stocks. Next is cryptocurrency. We obviously can't do justice in terms of defining crypto as a part of this video, as it's truly a complex subject and we might actually just do a separate video completely focused on crypto. However, we can simply just define crypto as a digital or virtual currency that can be bought and sold on exchanges. Like any other currency, the price of a crypto can increase or decrease based on a wide array of factors, including the push and pull of demand and supply. There are also a wide number of cryptos, with the most popular ones being Bitcoin and Ethereum. Finally, we have exchange-traded funds, also known as ETFs. You can think of ETFs as a single bucket made up of multiple individual stocks. ETFs can be bought and sold on exchanges, much like stocks, and the price of an ETF is a result of investor demand as well as the price of the individual stocks held in that ETF. ETFs can track an index like the S&P 500, the Dow Jones, the TSX 60, or the FTSE. They can also track a specific sector like the financial services, energy, utilities, and so on. Once again, we simply cannot cover everything about ETFs in this video, so we're most likely going to do a separate video just to cover up ETFs. It's important to understand the difference between trading and investing, as these are two very different approaches in terms of trying to make money off the financial markets. Trading is a short-term approach where traders try to make a quick profit by taking a buy position if they believe the price of a security will appreciate, or taking a sell position if they believe the price will reduce. These trades could be minutes, days, weeks, or they could even span months. Investing is a long-term approach to build wealth over a longer period of time. It involves buying and holding positions in stocks, ETFs, mutual funds, bonds, and other investment instruments. Investors will typically reinvest any profits or dividend payments back into the portfolio to take advantage of the compounded growth. Trading can yield higher returns. However, it's also very high risk, and according to stats, 90% of traders will end up losing more money than they actually make. Just to illustrate the difference between these four securities in terms of risk profile and returns, this follows the old age principle of high risk, high returns. Cryptos are extremely risky and volatile, but they can also provide high returns. Whereas, if we go to the lower end of the spectrum, we have bonds which are very low risk but also have the lowest returns of all the securities listed. Stocks and ETFs are right smack in the middle. Now that we've established that investing is the way to go, we would like to recommend 6 things to do before you begin your investment journey. We would highly suggest not skipping any of these steps to ensure you start your investment journey on the right foot. Number 1. Read a book to understand the fundamentals of investing in the stock market. Some books we would recommend include The Intelligent Investor, Simple Path to Wealth, Rich Dad Poor Dad, just to mention a few. This is a very important step and a fundamental one. No one should get into investments without educating themselves on the financial market and securities and how these all work together in unison. Number 2. You need to be free of any high interest debts. The calculations just don't add up if you choose to invest while still holding high interest debts. This is simply because the returns you will get from investment simply will not cover the costs of holding that debt. So you gotta pay off those high interest debts first. Next up is to save an emergency fund to cover your expenses for a period of 3 to 6 months. This should be kept in a high yield savings account to ensure easy access to the funds if required. This is simply to ensure you aren't forced to liquidate your investment positions to cover up any unforeseen emergencies. Imagine not having an emergency fund and having to liquidate your positions in the stock market in March of 2020 when the market dipped about 30%. You would have made a huge loss coming out of those positions and would have missed out on the tremendous growth that happened afterwards. An emergency fund will help prevent this. Number 4. Develop an investment strategy. An investment strategy basically serves as your guide and a blueprint for the decisions you will be making when it comes to investing. This is absolutely critical. you will need to have an investment strategy, preferably written down somewhere. A strategy will help you ground yourself in periods of uncertainty, volatility, and market corrections or crashes. We recommend 4 things to consider when developing your investment strategy. The first thing to consider in an investment strategy is what type of investment you would like to go into. Are you a day trader or a swing trader who is only interested in making quick profits in the short term? Or are you a long-term investor looking to actually buy and hold equity in your preferred companies for the long term? Do you perhaps want to do a combination of both? As you can imagine, our preferred approach is investing, and we favor long-term investing over some short-term gains. The next thing to consider is what to actually invest or trade in. This is a loaded question. Are you looking to invest in stocks, ETFs, crypto, or options? Once you decide what to invest in, you then need to go a step further to decide, for example, if you're focused on only ETFs, and if so, what ETFs to invest in, or if you're focused on stocks and what companies you want to invest in. Generally, for this, we would recommend having a mix of individual stocks and ETFs that track a major index like the S&P 500. Now, if you're willing to take on additional risk, you can also dabble into crypto, but we generally advise that you only invest money that you're willing to lose in crypto. This brings us to the next point, which is defining your portfolio makeup. It's perfectly okay to invest in a combination of these instruments, as we mentioned previously. So for example, you can own a combination of ETFs, individual stocks, and cryptos. In such a scenario, you need to define what percentage of your portfolio to allocate to each of these instruments. So for example, you can decide on 50% ETFs, 40% stocks, and 10% crypto. This is really going to be dependent on your risk appetite and how much time you would want to spend tracking your portfolio. If you are invested solely in an ETF that tracks the S&P 500, you literally don't have to track individual stocks or companies. But if you have positions in individual stocks, then you would want to listen to earnings report, go through financials, stay ahead of the news, just to ensure that you're still willing to have exposure to that company. If you are new to stocks, we would recommend having the majority of your exposure to ETFs with a few high conviction stocks to get your feet wet. Finally, strive to invest regularly and consistently. Develop a budget to ensure you have a consistent amount that you can invest on a regular basis. Investing is a long game. You've just got to keep at it and build yourself a nest egg. The more you invest, the more potential you have to increase your gains. Do this consistently, and you also get the effect of compounded growth. A $10,000 investment growing at 8% gives you a return of $800, while a $100,000 investment gives you an $8,000 return. The fifth thing to think about before you begin your investment journey is to understand what tax advantage investment accounts are available to you. A tax advantage investment account is essentially an account that allows you to hold your investments tax-free. So you can grow your investment portfolio without having to pay tax, or it allows you to defer the tax payment until a later stage, often at a lower tax rate. When it comes to investment, you can pay taxes on capital gains or dividends, or distributions in the case of ETFs. In a tax advantage account, you don't pay these taxes or they are deferred. This allows you to continue to see compounded growth in your investment portfolio. There are a series of tax advantage accounts as listed in the table below across Canada, the US, and the UK. These accounts are generally categorized as retirement accounts, tax saving accounts, or education saving accounts, mostly for your kids. Each of these accounts usually have an annual limit and also some rules in terms of withdrawals. It's always a good idea to max out your annual contribution limits into these accounts so you can take advantage of the tax benefits. The sixth and final thing to consider is where to open a brokerage account. There's a lot of options available across all 3 countries, mostly geared towards retail investors. However, there are a couple of key things to consider when deciding where to open a brokerage account. Examples are the fee structure, what market you would be getting into, just to mention a few. We plan to cover this in a separate video to do justice to this topic. If you have these 6 recommendations all figured out and answered, then you are well on your way to start your investment journey. That concludes our video for today. We have a pipeline of investment-related videos lined up, so stay tuned. Please note that the opinions and views expressed in this video are purely ours and do not represent any financial advice. Okay, thank you for sticking around thus far, and we hope you found the video helpful. Remember, we are a group of individuals who pool our significant, decades-old experience of living and working abroad to create this content. If you want specific advice or you have follow-up questions or comments, feel free to reach us through the comment sections. Also, don't forget to like and share. See you next time.